Welcome to our webinar today, looking at the new legislation surrounding financial emigration. This webinar builds on my previous webinars where we explored the intricacies of T-Day, another piece of legislation also coming into force this month. If you missed that webinar, you can find the recording on our website under the Innate Connect tab. But today, I'm delighted to welcome here with me virtually Tim Powell, Sable International's Forex Director. Tim has 25 years of experience in navigating complex exchange controls in both the UK and here in South Africa. Tim has worked for a wide variety of businesses, from his own successful startup to large multinationals like PwC, Deutsche Bank and Ernst & Young. Today, we'll talk in detail about the implications of the removal of financial emigration. And there are many facets to this interesting topic, but it's important to note today that Tim isn't a tax practitioner or indeed a financial advisor. He's speaking very much in his capacity as someone who works and understands exchange controls and foreign exchange. For those of you who are joining us for the first time, welcome. I'm Georgina Smith, and it's my privilege to look after the Innate distribution and client servicing teams. It's great to see so many of our advisors online today. Welcome. This session qualifies for one technical CPD point. A quick note on CPD: for those of you who watch today's webinar in full, you will receive a CPD point automatically via email. For anyone who didn't join us at the start of today or has to drop off early, or if you're watching the recording, or perhaps you're watching via someone else's unique registration link, you will need to complete a questionnaire to receive your technical CPD point. And this questionnaire will follow shortly after today's webinar via email. As always, we're happy to take questions via the Q&A section at the bottom of your screen, and we'll do our very best to answer as many as we can at the end of the session. So Tim, welcome. There have been several recent changes for South Africans earning money overseas, and phrases like expat tax have resulted in a huge amount of column inches and BRI conversations. Do you think this has contributed to the motivation behind financial emigration being removed and what we're talking about today?
Good morning, George, and thank you for having me and inviting me to chat about this topic. It certainly has got quite a lot of headlines and a lot of attention, and I think I just want to clarify, this is a change that's only been implemented as of the 1st of March this year, so it's very new, it's quite fluid, and we're learning all the time as to the exact implications for our clients. But BRI conversations, certainly. There's been, I think there was a lot of BRI conversations, particularly overseas, amongst South Africans living in the likes of Australia and Canada and the UK, concerned about the implications of this expat tax and how it might affect their earnings overseas. But let's just remember that today's talk is specifically about the changes to financial immigration. It's not really a tax conversation. There will be some tax elements brought into it, but it's the changes to financial immigration and how that's affected our clients. I agree with you. The changes to expat tax, though, from that 1 million tax-free amount to 1.250, did create a lot of concern amongst people around the world, particularly overseas. And I think there was a little bit of scaremongering, particularly by immigration businesses and some financial advisory type firms, that almost promoted the fact that SARS might be after your hard-earned dollars overseas. But I do think that the end to financial immigration has certainly put that argument to bed, i.e. that you have to financially immigrate to tax immigrate. And this conversation will sort of play out today, but I do think that has been put to bed at last. And I wonder whether the massive increase in financial immigration applications last year, particularly after the expat change announcements, didn't contribute to it to some extent.
Tim, can you perhaps give us some examples or scenarios of people who perhaps thought they were affected and maybe weren't, and those who actually were affected and did need to watch out?
Yeah, two simple examples. I mean, the person that packed up and went to Perth, they sold their home, they took their family, took their kids out of school, went to Perth and got a job. To me, they are, from a tax perspective, in terms of the two tax tests as such, that they're neither ordinary resident or physically present in South Africa. To me, the expat tax rule doesn't apply to them. It's that South African that works on an oil rig just off Africa. His wife he's still got a home here. His wife lives in South Africa. His kids are at school here. And he may have managed to, manage the number of days he was in South Africa to take advantage of some tax benefits. I think that person could possibly fall into that net.
Interesting, isn't it? I actually know a couple of people who were working on the oil rigs who actually did move overseas for exactly that reason. But surely it can't all be about expat tax, Tim. There must be other motivations behind this latest move.
Yeah, I agree. Look, the SARB are looking to simplify exchange control, and they're changing towards this capital control system. But one wonders whether one of the bigger motivations wasn't SARS. SARS possibly have recognized there's been so many people that have gone through this financial immigration, so many people that have moved overseas, and probably unawares of the implications of going and becoming non-tax residents. And there's something called tax immigration, which again we will elaborate on through today's talk, that I think a lot of people unknowingly going overseas didn't realize the implications of that tax immigration. I mean, most people, when they go, they sell up, they sell their shares, they sell their home, they move their money, and they submit their final tax return, and it's a simple process of getting overseas. But for higher net worth people, there is an implication of this tax immigration with a deemed capital gain.
Well, let's talk a little bit more about tax immigration. Can you tell us a bit more about it? What is it, and what are the implications of it?
So let's clarify the difference between tax immigration and financial immigration. Obviously, financial immigration is no longer, but financial immigration was a process of dealing with the Reserve Bank, South African Reserve Bank. You were placing your immigration on record with the Reserve Bank, and they simply changed you from there were all these different categories. They changed you from being a resident or South African resident temporary abroad to a non-resident, and they treated you as a non-resident. Tax immigration is a matter of advising SARS that you're no longer resident in South Africa for tax purposes. So the one you're dealing with is SARB, and the one you're dealing with SARS. There is no connection. One would think that they communicated, and that, like I said earlier, might have been some sort of motivation behind these changes. But they're definitely very different entities that you're dealing with. Just briefly, in terms of tax immigration, it's not a complex thing to do. I mean, on e-filing, there's actually a tick box in the wizard when you're setting yourself up, where it actually asks, were you non-resident for any period of the tax year? And if you tick yes, then I think you get an option to put in a date, and that has implications from a tax point of view. I think very briefly, it's just worth talking about the implications of tax immigration, and I mentioned particularly for the sort of the higher net worth people. And if I give you an example, someone who leaves South Africa, let's say they've got a share portfolio in South Africa, they've got a home, and they've got an RA, and let's say they've got a flat in London from times before when they worked in London. When they leave South Africa, on the tax immigration date, and we can discuss how that gets determined, on the tax immigration date, essentially a line gets drawn in the sand as to the value of those assets. The movable property falls outside of that net. The cash you expected they would move using their allowances. The RA will get stuck here, as we'll talk about. But that share portfolio and the value of their property needs to get valued. So the share portfolio probably increased in value, and the value of the property is increased in value. And a deemed capital gains tax gets imposed on those assets, so whether they sell them or not. So it obviously has a bit of a cash flow implication and a liquidity issue for the client, particularly if it's property. But that's what people need to be aware of. And people going overseas, moving overseas going forward, probably need tax advice, particularly when they fall into those sort of categories.
And it was always about drawing this line in the sand, and it was always the process, wasn't it? There's nothing new here. Do you think people did adhere to this as they should have done?
Absolutely. It's always been a process. This isn't new. Tax immigration is not new. The exit tax, for use of a better term, the exit tax is actually the deemed capital gain, is not new. I suppose it's just something that people may not have been aware of. Look, that doesn't absolve you from doing it, but I do think there's, to some extent, people just packed up, submitted their final tax returns based on their earnings in South Africa, possibly the following year did a null tax return or deactivated their tax profile with SARS, and quite possibly ignorance was bliss in this situation.
So let's move on to talk about the financial immigration part of it. Why would someone have wanted to financially immigrate in the past?
Okay, so one of the big things we've obviously seen is financial immigration to tax immigrate, which I think I've made clear was not the case. You didn't need to financially immigrate to tax immigrate. But the three main reasons, to me, there's three main reasons people in the past financially immigrated. The first is the one probably most people are listening in for today is to encash your RA. The rules in 2008 were changed to allow that people with a retirement annuity pre-retirement date, which is normally 55, could encash their RA if they did something called financial immigration. They obviously had to live overseas to benefit from that, but if they went through the financial immigration process, they could then go to their provider, encash their RA, pay their tax, get the tax directed, and move those funds offshore. There's two other instances where people would financially immigrate. The first being inheritances. So when people living overseas inherit from a South African deceased estate, typically they would use their allowances. There's the 1 million rand single discretionary allowance, and there's a 10 million rand foreign investment allowance. But many people who inherit, and we see this more and more, left when they were kids. They might have been 4 years old when their folks took them overseas, and now they're 20 something or in their 30s or 40s or even 50s. And they're inheriting from a South African estate. They don't really have a footprint here. In the past, they could do something called a belated immigration. It was the same as it is financial immigration. It was just a simpler process because they had no assets. They didn't have a tax number. It was, they still had to fill in that MP336B form, but it was quick. Once we got the documentation back, pretty much within a week, the state could then pay those funds off over to that beneficiary. And the third instance of financial immigration was high net worth people. So again, you've got the 1 million and the 10 million allowances. As a married couple, you've got 22 million rand that you can move overseas, it's a calendar year. So depending on the time of year, obviously if you're in February, you've got to wait a long time. You've got to wait 10 months to use your allowance again. But if you're in November, you only have to wait 2 months to use your allowance again. But let's use an example of someone with 250 million. They could have gone through financial immigration. They would have gone through quite an extensive tax clearance application process. But once they got it, they would have been able to financially immigrate and they would have been able to externalize all those funds. So with financial immigration being removed, these options now are different.
And what are the particular changes that are coming into effect, Tim?
So the change is quite simple. From the 1st of March, there's no more financial immigration. So it's no longer an option if you want to encash your RA or claim or receive a payment for an inheritance, or you're high net worth people, financial immigration is no longer an option. What you're going to find, it's been replaced by a much more stringent SARS tax verification process. So the 1 million is still in place. The 10 million is still in place, and then we will have something called special applications for transfers over and above the 10 million. But in a nutshell, that is the difference. You are actually no longer dealing with the SARB. This is all about SARS. SARS are taking an interest in the individual to make sure they are compliant in South Africa, and they move their funds overseas. The other big change, particularly with regards to the financial immigration, specifically to the retirement annuity, is this 3-year rule. So you have to demonstrate that you've been non-tax resident for 3 years, 3 consecutive years, before you can encash your RA. And that is where I think the clarity still needs to come, because the rule is clear. It's 1 March. The rule is clear. There's tax verification with SARS, and the rule is clear that you have to prove 3 consecutive years non-tax resident. It's what you have to put together to prove the 3 years non-tax resident. And that 3 years non-tax resident is proof to the provider. So SARS, you've got to get proof compliance. The provider, you have to prove you've been out the country for 3 consecutive years.
So, Tim, what you're saying is that if you leave South Africa tomorrow, say the 17th of March, you may well be deemed to have tax emigrated on the 17th, but you still have to wait 3 years to access your RA, and you need to demonstrate 3 consecutive years as a non-tax resident. But what about those other 2 groups you spoke about, those guys who are inheriting money and those guys who have significant assets?
Okay, so those are the 2 that I think. Well, no, it's the inheriting people. I think that for now we need more clarity. The high net worth people is clear, and I'll just elaborate a little bit more. So the people inheriting, they no longer have the option of belated immigration. So that if they have the 1 million and the 10 million allowance available to them, but there's so many variables here. If they've lost their ID book, or they can't find their South African ID, that is key to using the allowance. It's one of the requirements. So we actually had a call with a senior SARS official a couple of weeks back just to chat about certain implications, and they're very aware of these different scenarios. But understand that this rule was only passed in January this year. SARS, their words, that they obviously everyone was very aware that the changes had been proposed, but SARS were not going to change their systems until such time as it was promulgated and passed by Parliament. There's a big cost to implementing new systems, and obviously a lot of time and effort goes into it. So given it was only passed in January, they are still looking at all these different variables, and there's lots of different, 90% of the people we can cover with the changes, but so it's 10% that they still need to address. But that person that's inheriting, we use that example, if they can't use their allowances, for now, it's going to be a manual application to the SARS. Every single cent that leaves the country now is going to require tax verification. It's going to require a SARS PIN, but with those individuals, it's going to require a manual application to the SARS for now until that's clarified. So those people, unfortunately, where I mentioned they probably could be done in 7 to 10 days, I think there's going to be possibly a little bit of frustration and a little bit of delay, but I do think within the next 4 to 8 weeks, it'll get clarified in terms of exactly how to deal with them. The high net worth people, well, they can actually make a special application to move as much money out the country as they like. When you send out 1, you don't need tax clearance. When you send out 10 million, you do need tax clearance, and it's actually quite a straightforward process when you prove source of funds. Anything over and above goes to a special department at SARS. We're aware of that. It just requires, it comes under more scrutiny. It actually goes to a special division within SARS where they will look to see if there's any attached or associated related companies, trusts, etc. And they will just turn over every stone in that individual just to make sure they're absolutely compliant. But over and above that, pretty much any amount can be transferred out of the country. More than 10 million does come with a reporting requirement to the SARB, but we're dealing with probably quite a small minority of people here.
So if I may, Tim, I'm going to run a few scenarios past you, if I may. I've got an auntie. She was born in South Africa. The only thing she's got to show that she's South African, though, is a South African passport, because she moved to the UK when she was 2 years old. She speaks like I do. She has very little to do with South Africa, but it turns out her auntie, my great aunt, has passed away and left her 500,000 rand. What is it going to be like for her, and is it going to be easier or harder than it was before?
In a nutshell, right now it's going to probably be a little bit more difficult. So in the past, pre-1 March, she would have simply done that belated immigration. She would have proved her citizenship in the UK, and the estate late would have been able to pay her funds away to her. For now, she's going to have to just do a manual application to SARS to get permission to send those funds offshore. Again, when we spoke to the SARS consultant, and this gent was 20 years at SARS, and they're aware of the scenario. It's not like they're not aware of it, and they're trying to address it. Their words that this person was not a tax risk to South Africa. This person, their state would have paid any taxes. This person has been out the country since they were 2 or 3 years old. Again, not a tax risk to the country. So that inheritance will be able to be paid overseas. We just got to fine tune the sort of dot the I's and cross the T's. I think the interesting one will be if the person's inheriting, let's say, 20 million, because we've seen that. I've seen 150 million inheritances. How will SARS deal with that one? Because that is over and above the 10 million. It goes to a special department, but we know it's not a tax risk. So I think these are going to have to be dealt with on a case-by-case basis for now. Fortunately, in our business, we've got a very good tax practitioner that got these contacts at SARS, and it is about communicating with SARS. And you'd be surprised, SARS are actually quite good at giving you access to people that can answer these questions.
Yeah, we tend to think of them as a kind of faceless corporate or organization, but my experience as well has been that they are very accessible. So here's another scenario for you, Tim. Let's say a gentleman left South Africa when he was 40 years old. He's now 45. It was 5 years ago. He hasn't done anything with his RA. He just left it here. Tim, what should he do, or what can he do? What did he have to do before, and how is it different now?
Okay, so this is the person that I think is better off. Okay, because he hadn't moved his RA. Now he can benefit from the new rules. So if I talk about the past, if he wants to encash that RA before, he would have had to go through the financial immigration process, which most people listening are probably familiar with. It's an MP336B. It's original, so it's got to come from Australia back to South Africa. It gets sent to a bank. It gets stamped. It then goes to SARS for tax clearance application with all the supporting documents for the assets. It then comes back from SARS with tax clearance and a PIN. Then goes back to the bank. They open up this blocked RAND account, which everybody used to talk about. Then only were those details sent to the provider who provided the RA. A tax directive was obtained. The taxes were deducted. It was encashed, paid into the blocked RAND account, and then the funds would flow. So now this person doesn't have to deal with the SARB anymore. There's no more MP336. They still have to get the tax clearance from SARS, so they still need an active tax number. They still need to have their tax profile up to date and have all returns up to date. But they get the tax clearance, they open up a bank account in South Africa, and if they don't already have one, they can have they've got to, this is where this objective part is, they've got to demonstrate to the provider that they've been they've been tax resident in another country or non-tax resident in South Africa for 3 consecutive tax years. And then only will the provider, they still need a tax directive, and the provider will then encash and pay into the South African account. The variables will come in. Well, we know if they've got a South African ID, I believe it's an easier process right now. The variables will come in if that person doesn't have a South African ID. Because at the moment in South Africa, the banking system only allows you to open an account as a resident if you've got an ID book. You know, if you didn't have an ID book, you would financially immigrate, open an account based with your passports, and the bank would open a non-residence account, which was the blocked RAND account. So we still, and I know the banks met last week, all as a unit to brainstorm this. They're presenting it to the SARB in terms of what will come. Solutions will come. They're very aware of this. But you know, for now, if you've got a South African ID and you're that 40-year-old, I think it's a fairly simple process.
And we think those solutions will come quickly as well, don't we, Tim?
I do. I think by the end of April, I suspect you'll have clarity on all of these.
Yeah. So what about the South African who's been overseas, let's say just for fewer than 3 years? They've been out of the country for 2 years. How do these changes affect them? And what did they do before, and what will they do now? And Freddie, I've seen your question. I think this is going to answer your question, Freddie.
So quite simply, that person can't do anything. That for use of a better term, that RA is now trapped in South Africa until they've done 3 years. Okay, and the 3 years starts. It's not a tax year. It starts from the date that they left, or the date that they departed South Africa, or the date. Let's actually reword that. The date that they can demonstrate that they became tax resident in another jurisdiction. And we will talk about this a little bit at the end. But what can they do? They're going to wait. So the closer you are to 3 years, obviously, the less time you're going to wait. The further you are from 3 years, the more you're going to wait. The maximum you're going to wait is 3 years. For now, there's not even any point in getting tax clearance, because that tax clearance is only valid for 12 months. So if you get your tax clearance and it then expires, you're just going to pay to get that again. So for now, best thing they can do is just be aware of what's required and keep a tax record up to date. And also establish what you can get from proving that you've been non-tax resident for 3 consecutive years.
But people moving overseas, Tim, they often use their RAs as a deposit on a house or for the first few months' rent. Often they're moving to more expensive countries. Perhaps the rand isn't in their favor at the time. This is actually going to make moving overseas quite a bit more challenging for some people, isn't it?
Definitely, definitely. I mean, we're not. This isn't a big part of our business. It's certainly a part of our business. We do, we probably do 30 or 40 financial immigrations a month, or we did. And a lot of those people they're doing it because they are setting themselves up. It's a deposit on a home. It's just a setup cost. It's expensive to go to another country. But the bottom line is it's not an option anymore for those people.
Okay, so what about those people who are thinking of emigrating in the near to medium term future? What about them? What should they do?
Look, they must be aware of these changes, and I think this is the benefit of this webinar to all the listeners out there, because these are your clients, that you will know are moving, but they just must be aware that these changes are in place. But I think equally important, they must be aware that there are tax implications now, and SARS are placing a bigger emphasis on this tax immigration. So when we spoke to the SARS consultants, they're not targeting all the people that have already left to make them tax immigrate. I suspect that they would like those people to tax immigrate, particularly the high net worth people where the deemed capital gain maybe hasn't been addressed properly or computed and paid. But for people going forward, tax immigration will be required. They're going to have to tax immigrate. And again, it's not a difficult process. And for the majority of our clients, there's not a deemed capital gain event. But for the high net worth people, there is that deemed capital gain event.
And let's just remind ourselves that tax immigration is not a choice, is it? It's defined based on your circumstances.
Definitely. Yeah, I do think there's people out there that think it's a choice.
I think you're right.
It's based on.
Sorry, go on.
It's definitely based on your circumstances. If you have moved to another country and you've become orderly resident, for use of a better term, in that country, you've become tax resident in that country. And I think that the timing of tax residence the timing of tax immigration is possibly subjective. There's probably a window, and it's not a huge window, but there's a window that is available, and there may be some benefits to delaying tax immigration. But if I use an example, I think you use the example of departing on the 17th of March. Let's move that date out a little bit because it's a little bit close to 28th of Feb tax year end. But let's go 1 November. So let's say, a person departs on the 1st of November and so that's the date they get on the plane. There's no. My understanding is there's no case law yet to determine a tax immigration date. It's subjective, and that person, for example, 6 months prior to that could have started looking for a job in the UK. A month later, found that job. So 5 months earlier than 1 November, they've accepted a job in the UK. They've actually notified their employer in South Africa that they're leaving. They've given notice to the school that their kids go to. They've put their house on the market. There's an argument that tax immigration might have started on that date. Equally, that person might have got on the plane the 1st of November going on a sabbatical, and 3 months later found a job that they love in Australia, or just really enjoyed that part of the world. And only at that date did they then put their house on the market back in South Africa. And they may have resigned from their job or taken a sabbatical and they resigned from their job now. So there is some subjectivity, and I think there's some small. I'm not a tax person, but I do think there's some small advantages that can be taken of if you can time your tax immigration a little bit. There's that. What is it called? The capital gains tax, sort of that 40,000 Rand exemption that you could possibly use to some extent if you could use it over 2 tax years. But there's not a massive benefit. When you tax immigrate, let's say it's 1 November, you actually end your tax year on that date, and then you start a new tax year on the 2nd of November.
So Tim, I just want to circle back to the 3 years, if I may. Where does the 3 years come from? I know there are cynics out there, commentators, who feel that this is an effort by the government to hold money domestically for longer. to perhaps entrap it in Reg 28 and potentially prescribed assets. What do you think, Tim?
I'm going to give you a diplomatic answer here. I think you've got to remember that these were retirement funds. So it's, maybe there's an argument that the client is actually being protected a little bit by not allowing them to just encash these funds, because once they encash, they become discretionary money, don't they? You can choose what to do with it. You can blow it if you want. So there's an argument that you're protecting the client a little bit. I'm not going to go into the prescribed assets conversation, but I think this is probably where the financial advisors listening can play an important role with their clients, because the bottom line is that money needs to remain invested for a period longer. Some of those clients might have a view, or a lot of them will have a negative view on South African, on the currency, on our sovereign risk. And there might be opportunity to just diversify a little bit and look for more rand hedge type investments if it's available in the product. And also, I think there's got to be some more consideration about this encashment, because once you encash, you've paid your tax. If you choose to if you choose to come back, you don't get that tax back. So one could argue that the 3 years is a bit of a cooling down period to just make sure that you really like the country you're going to.
Absolutely.
Sorry.
No, go on. You carry on, Tim.
The one other thing that the advisors out there, I think, can play a bigger role in is the decision to encash or wait for, encash with early withdrawal or wait for retirement age on that 55, because they're very different tax tables. The early withdrawal is at 25,000 Rand tax-free, whereas the retirement tax tables is 500,000 Rand tax-free. And it's very much a function of how close they are to retirement date and the size of the investments.
Yeah, absolutely. I'm glad you didn't go down opening the Pandora's box of prescribed assets, but there's a real role for a value add role for financial advisors to play in this space, without a doubt. People aren't going to be able to navigate this decision without help, in my opinion, anyway. Are there any ways around these changes, Tim?
The long answer is no, not really. I actually think for South Africans living overseas that have been over there for more than 3 years, they're better off. We've made it clear if you're in the 0 to 3 category, and we've also made it clear if you haven't considered going yet. There's just probably a little bit more planning required and a little bit more thought and less dependence possibly on the RA. I think for the people that are inheriting the process of that belated immigration, that just needs a little bit more clarity, but there's no way around it. You're just going to have to do your own research, find businesses that can assist you to get those funds out. There'll always be a solution, but we just got to accept that financial immigration is not an option. I actually think there's a bit of a benefit in it, to be honest. That blocked Rand account was often quite a cumbersome account. It came with limited functionality. I mean, you weren't allowed a credit card on it. You couldn't get debt, or it was an issue getting debt. Helping a client that had a property in South Africa and still had a mortgage, a bond. It just came with implications. But now a South African living overseas can keep their South African bank account going. They don't have to worry about this blocked Rand account. I mean, if you walked into a bank this time last year and said I was going to live overseas, they would default you to financial immigration. You've had a bank account, you want to keep it going. You've got life policies here, you're supporting parents, you want to keep that account going. And they would just default you to financial immigration. They'd put that MP336 in front of you and almost tell you that was your only option. So I think there's a little bit of a benefit in this.
And so what you're saying, Tim, is that the frustrations that a lot of people will have felt trying to financially emigrate have lessened for most people. I think it's interesting as well, Tim, isn't it, that there's a huge cottage industry that's sprung up over the last decade or so, helping people with financial emigration. Are these businesses necessary anymore?
Yeah, that's a good question. Look, our business helps people with financial immigration, or we certainly help people with financial immigration. Definitely a big cottage industry grew, and I think it grew even faster last year with Section 1010 and the expat tax rule changes. I actually know of one business that did about 300 or 400 financial immigrations a month. And there are probably more than one businesses that did that. But I do think there's still a place for these businesses. I mean, in the past, it was complicated. It was a long, drawn out, complicated process. It would take, if you got it done in 3 months, you did well. Whereas now, I think the process is going to be quicker, but there's still going to be many variables. A client can definitely do it themselves, but they're going to have to make sure they've got an active tax record. It often involves an inquiry with SARS to make sure your profile is active or what the status of your profile is. We call it a status check. It's a matter of making sure your returns are up to date. Then you need a bank account in South Africa. You then have to you also have to get tax clearance with SARS. You're going to have to communicate with the company that's holding your RA, the investment company, around demonstrating 3 years non-tax residence. And then you're going to have to communicate with them with getting this tax directive, which is still a requirement, and then in cashing. So I do think there's room for a service here. I mean, our businesses, we're still focusing on it. We still get a lot of inquiries, and we've already started to help clients post 1 March that fall into that have been out the country for more than 3 years. It's a bit of a learning process, and we'll learn on the fly. But I do think, I think the benefit to the clients is that the fees will come down. They should. There were some businesses charging quite exorbitant fees for the service. In our business, our consideration is the fee should halve. I think the time frame is going to get shorter. There's less work involved. There's less back and forth. So hopefully, and also there's that MP336 is gone. That was a bit of a pain because it was always an original. So now everything can be done digitally and electronically. So I do think it'll be a simpler process, but look, I guess I'm hoping that the industry still stays.
So just in summary, 3 points, Tim. The upsides of this new legislation, what would you say?
So it's a simpler process. Okay, simpler process, it's quicker, and it's got to be less costly for the clients, and they'll probably be more prepared to pay the fee now. Because when you're living overseas, it is a lot of admin. There's no more blocked rand accounts. I think I've talked about that. And then, of course, for clients that have been out the country for more than 3 years, they can actually get going quite quickly.
So, Tim, we've looked at what's coming down the line in terms of tax immigration implications. Are there any exchange control implications that you're aware of?
Oh, look, there's a couple of other proposed changes coming. I think just to let's just pause a little bit and just remind ourselves how the SARB have actually liberated exchange control over the last 20 years. I mean, if you go back to 2000, I can't remember the exact amounts. I think you're allowed 750,000 Rand travel allowance a year, and that's when a lot of the SVDB things came in. And then in 2006, they introduced the 2 million Rand foreign investment allowance once in a lifetime, and we all thought, wow. They increased that to 4 million in 2008, I think, once in a lifetime. And we all thought, wow. And in 2009, a year later, they made it 4 million Rand a year. So someone who could do 4 million Rand once in a lifetime could now do 4 million Rand every single year. And then in 2015, they increased the 4 to 10. So you have seen quite a lot of liberation already in exchange control. And for all intents and purposes, for the I use the word average for most South Africans, that covers their needs. There is one change that's been proposed that's very relevant to this RA topic. It's a bit of a mouthful, and if I was to read the actual legislation, I think I would get a little bit tongue-tied myself. But if you don't mind, I'll read my interpretation of these changes. But bear in mind, this is a proposal. This is not promulgated. It's going to be discussed, and it's going to be discussed a lot in the tax community, I expect. But in a nutshell, it's a change to RA in the essence that from a date you become non-tax resident, so you tax emigrate. It's as if you encash your RA, right? And the deemed disposal tax is calculated at the tax withdrawal rates applicable at the time, so at the date of your tax immigration. The tax, however, is deferred until such time as that encashment actually takes place. So you don't have to pay the tax, but the tax has been calculated. Okay. In addition, though, interest is calculated on the tax payable from the deemed withdrawal date. All right. So I think this is where the controversy might come in. And this can be quite punitive, given, or to me anyway, in my opinion, given that you have to wait that minimum 3-year period. Okay. And what if you're 40 years old, you tax immigrate, you incur the tax disposable, but only if eventually in cash 8 years later, for whatever reason? You might decide you actually don't need the money overseas. The investment might be performing quite well in South Africa, but that deemed disposable has been determined, the tax has been determined, the interest is accruing, but you leave the investment here. So there's quite a lot of implications that need to be considered to me still.
Yeah, and let's take that example a bit further. So you've got a 40-year-old, they've got a 1.5 million RA, they're going to tax emigrate. What does this actually mean for them in numbers, Tim?
Yeah. So I've actually looked at the tax tables for that specific example, and if they tax immigrate and then deemed disposal takes place, it's calculated on the withdrawal table, which is the first 25,000 Rand tax free. So the actual tax that is calculated on that 1.5 million is 387,000 Rand, which is almost 26%. Okay. And that amount of 387 is accruing interest, in my understanding, from the deemed withdrawal date. So it's going to accrue interest at SARS's rates. If that person was allowed to retire from it, so that 40-year-old, and you can take the different ages, but are allowed to wait to 55 and retire, assuming a 1.5 million Rand, the tax on that is 292,000 Rand. So it's only 19.5%, very different tax rate. Okay. If that person, what this proposal does allow though, is if that person does wait till retirement date, so the deemed disposal is determined, if they wait till retirement date and a different tax table is used, a tax credit will be issued. So the 387,000 might have been deemed a tax credit for, an actual tax rate might be calculated because they wait till retirement. The tax credit is issued, but then what happens to the interest? We don't know. The interest has been calculated on a higher value, but now there's a tax credit on a different tax table. What happens to the interest? I think that's got to come out in the wash, and that will get, I'm sure that'll come up in amongst the tax community who will, for use of a term, lay their objections.
Yeah, I think you're right. I think this is probably, I've seen a lot in the press about this. I've seen a few questions come in the questions around this. And I think a lot of it, of course, will need advice from the client's financial advisor. And a lot of it will depend on how close the client is to retirement age as well. There's a lot of unknowns around this, aren't there, Tim?
One consideration that needs to take in place. There's a lot of consideration. So it's important to just be aware of it. And I do think tax advice is going to come into play for a lot of people that leave the country.
Yeah, without a doubt. One thing I just want to clear up, in that example we just spoke about, they've tax emigrated. Do they still have a tax number, and can they still pay tax in this country?
Can they still? I'm sure they want to pay tax. If they've tax emigrated, look, it comes to that ordinary residence and physically present test. They probably, use a better term, fail both of those, so they tax emigrate. But if they still have South African sourced income, they will still need to pay tax on that income. In South Africa, for all of us probably listening to this, so long as we're sitting in South Africa, our worldwide income is taxed in South Africa. Once you tax emigrate, you've moved to a different jurisdiction and your income is taxed in that jurisdiction. But if you have any income in South Africa, particularly I would say rental, so someone might have retained a commercial property portfolio or a residential property, or you might have pension income, that is taxed in South Africa. So yes, you do still need to retain your tax number. Yes, you do still need to submit tax returns and pay your tax in that instance. It does get a little bit complex, particularly where there's pension income around double tax agreements. But this is where clients must seek tax advice, which is relevant to the specific jurisdiction that they've gone to determine. Because I do know pension income, you can get paid the gross and pay your taxes in another country, but it's very much dependent on the double taxation agreements. And I understand it's not a simple process. Like there's an annual application to SARS. I can't remember the name of the form, but there's an annual application to the SARS that needs to be made.
Tim, slightly off topic, but with the new changes coming into effect with respect to the RAs and financial immigration, is it likely there'll be any changes coming into effect to allow, say, a living annuity to be fully commuted on emigration?
No, not that I'm aware of. Once you've for use of a term, purchased that living annuity, you might have taken your 1/3 withdrawal. You are tied into that product. So as far as I know, and I'm very sure of this, you can't encash that living annuity. And again, this is where the advisors come into play. If the client is overseas, they may look at some sort of product that gives them more rand protection. Again, there's the 2.5% withdrawal versus the 17.5% withdrawal. There might be some discussion around that to try and accelerate the withdrawal of the living annuity, but you can't get the capital out of the country.
So what would be your suggestion for a client looking to encash their RA now?
It's very much a function of what stage they're at in terms of that 3-year rule. So let's just break them into the 3 categories to summarize. If you've been out of the country for more than 3 years and you've got a South African ID, you can go ahead, I think. Okay, and I think it's very simple. If you haven't got an ID, you're going to have to just communicate probably with a business like ours, and we'll look to see what that option is around, because it's actually around opening the bank accounts. Okay, the 0 to 3 years people, they must just be aware of the fact that they've got to wait that 3-year period. And equally, the people that are considering or going to leave South Africa, they must be aware that they're going to have to wait the 3-year period. But what they can do, and I suppose a useful tip for those 2 people, is to start getting their house in order, because they've probably got their own homework to do. Make sure you've got a tax number, make sure your tax profile is up to date, because you're going to have to be compliant. If you're going to leave post 1 March, be aware that you must tax emigrate, and that's that exercise on e-filing that we spoke about. But I think the important one as well is going to be determine what you need to provide the provider to prove that you've been tax resident in another jurisdiction for 3 consecutive years. This is the subjective one. When we spoke to the SARS consultants, he gave us some guidelines. Again, it's not cast in stone yet. I think everyone's going to learn from each other quite quickly on this one. The obvious proof is that some countries issue a tax certificate. Apparently the UK does, Australia does, New Zealand does. Some countries charge you for it, some provide it freely. I don't know how long it takes to get, but you get a tax certificate which acknowledges that you're a tax resident in that country. But some countries don't issue a tax certificate, and some countries possibly don't even charge you tax. But you, it may be a function of some or all of a letter of employment from your employer in that country, maybe your bank statement to show when you started receiving payment from that employer, maybe a proof of address to show that you've been resident in that country from recently and maybe 3 or 4 years ago, and maybe a visa or a citizenship certificate or a passport to prove that you have the right to live in that country. So it's going to be a function of those things, but that's the homework that those people I expect are going to have to do.
Absolutely. Tim, I think we've covered a lot of ground there in terms of what it means for different people in different circumstances. The questions have come in thick and fast today. Let's see how many we can answer, and we're going to follow up afterwards with answers to questions we didn't get to. This one circles right back round to the expat tax conversation we had right at the beginning, right at the top of the show today. If you're working in a tax-free country, but you're living in South Africa, how are you taxed in SA, or you're just working in, say, Dubai, and but your family's still based here? How are you going to be taxed, Tim?
So look, I'm not a tax advisor. I would say that person needs tax advice, because there's all those variables. This is where Section 1010, I think, targets. So that person needs to go to a tax advisor. If they haven't got their own tax advisor, you can, if you can't help, you're very welcome to put that person to me, and I can guide them. But I would have to point them in the right direction of speaking to a tax person to give that advice.
Quite right, Tim. Thank you. So a question here from Louis. Hi, Louis. Thanks for joining us. If a client, this is a nice one for you, Tim. If a client has been living abroad for, say, 2 years and then they pass on, when will his beneficiaries be able to receive the funds in his RA?
Well, that comes down to the rules of the RA. So normally once you provide, because my understanding is that falls outside of the estate. okay, and the beneficiary has been listed on the RA. So one would expect that once you can provide the RA provider with the death certificate and the will, it's up to how quickly they can process it.
Thank you, Tim. Moving to blocked RAND accounts, we've talked about them a little bit. Is it possible now to unblock a blocked RAND account for a client who emigrated many years ago? Thank you, Sharon, for that one.
Yeah, and that is such a good question because, and I don't know the answer to that yet, but I imagine it's one that's going to come up more and more, because if it was me, I would want to unblock my blocked RAND accounts, but as far as I know, the answer is no right now, because people that prior to, there's almost two types of people now. There's the people that immigrated prior to 1 March and the old rules apply to them, but I would expect it only applies to so few people, because most people, once they open that blocked RAND account, they've externalized everything and they don't really have a function for it. But again, I expect that that's one that the banks are asking, and look, she's very welcome again to have my details. And as we learn, we will write newsletters and communicate this information.
Oh, absolutely. And thank you, Tim, for that. Covers Klein, thank you very much for this one. This is a lovely, gnarly one, which I think we can really get into some interesting debate on this. But a lot of the answer, I think, to this is unknown. But he says it must be beneficial to wait until age 55 and take retirement from your RA with a larger tax-free amount and clean it out over 6 years with a 17.5% annual living annuity.
Look, that's very much a function of how old the person is. Look, they could be 35 and they've got to wait 20 years. They might be 35 with a 3 million rand RA and they've got to wait 20 years.
And have interest charged on that as well.
If that proposal gets passed, proposal gets passed, it's very much a function of, to me, how far away you are from 55, the size of the RA, and ultimately the appetite that the individual has for leaving their funds in South Africa. And look, even if the closer you are to 55, in my view, the more likely that becomes a very serious consideration. But the 17.5% he says should get wound down within 6 years. One would actually hope not, because let's hope that investment's actually increasing as well, because it's invested in the market. So generally it does take 7 to 8 years, but I think that's neither here nor there. But that's a good question, but I think it's very much a function of how close you are to that retirement age.
Absolutely. Thanks, Tim, for that. A question from Robin. Hello, Robin. Nice to see you. Thanks for joining us today. With the tax treatment of this process seeming to be more stringent, with a focus on tax residency only, does this possibly make it more onerous to overcome the burden of proving non-resident tax status?
No, that's a good question. I don't think so. It's not the SARS are being more stringent in terms of the compliance. All they're saying is, if you want to move your money out the country, in my view, if you want to move your money out the country, you need to be compliant. You need to have submitted your tax returns, and you need to show us your source of funds. So it's almost like a reasonable assessment. That's a reasonableness assessment, sanity test, for use of a better term. Okay, to meet their compliance requirements. So I don't think it's any more onerous. I just think there's more responsibility on the taxpayer to ensure they're compliant if they want SARS to sign them off to allow them to remove their country, to remove their funds. Proving non-tax residence, I think, is going to be, the subjectivity will go away, because you'll be able to demonstrate non-residence in another country. If you submit a tax return in another country and you physically pay tax in another country, you'll be able to prove it. But again, I'm not a tax person. This is my experience from a lot of stuff that I've read, and it's obviously very much in the news and commentary at the moment.
Thanks, Tim. There's a question here from my mate Jen. Hello, Jen. Great to have you with us this morning. How do you keep your tax records up to date if you are non-tax resident during those 3 years? Do you still need to do a tax return for those 3 years, even though you are not a tax resident?
That's a good question.
You see, you knew you'd get a good one from Jen.
Yeah, I know, but so Jen's not a tax person again, but I would suspect you don't have to keep your tax returns up to date if you tax immigrates. So on your e-filing, you tax immigrates, you file your final return. It's not, I've got to watch out here because you've got to go and get tax clearance, don't you, after 3 years? So that's a good question that I think that'll play out. One would argue you'd have to continue to file nil returns until such time as you want to get that tax clearance. Yeah.
Thank you. So quite a few questions coming in about the timing. I think there was an assumption before this webinar that your 3 years would start from the 1st of March. But we're saying that's not the case. And let's just clarify that with a question from Curvus. So a 40-year-old out of the country for 2 years, 11 months can withdraw or encash their RA after April 2021.
Correct. Yeah, I'm clear on that.
Let's look at another one. So what if you emigrated but kept your South African residency? In other words, they retained their South African ID. They have no property here and their family is overseas and all their assets are overseas. Is that even possible, Tim?
Yeah, that's definitely possible. I mean, I'm not quite sure how I'm not quite sure of what they're concerned about in terms of implications because there aren't any. They've immigrated. When you immigrate, I assume they mean, when you say immigrate, you mean financially immigrated or immigrated? Because they're different things, aren't they?
Yeah, let's just call it emigrated here.
Immigrated, it means immigration is the act of actually leaving a country or moving countries, isn't it?
Yeah.
Financial immigration is pretty much unique to South Africa because it's an exchange control thing. All right. So it's quite possible to have immigrated with an ID number and externalized all your assets through the allowances.
Tim, what are the reporting requirements? This is from Johannes. Hello, Johannes. Thanks so much for joining us. What are the reporting requirements that you referred to when a high net worth individual takes more than 11 million offshore on a special application? What are those reporting requirements?
That's a good question. It's quite simple. You report back to so when you apply for that special application, SARS give you tax clearance. It can take a long time to get. I've seen them take 8 months, depending on the complexity of the person's affairs. But once you get the clearance, you then go to the SARB for approval, and that's actually a formality. So you go to the SARB and say, I've got tax clearance for 200 million Rand. I want approval, and they'll give it to you. But it'll come back with a condition that every year you need to report back to the SARB on where that money is invested and how it's performed and the return, because they're almost looking to the benefit to South Africa.
Tim, we've run out of time in terms of questions. There are still quite a few that we've not been able to get to. Thank you so much for your vast pools of knowledge today. Thank you very much for your time. Before I move off that, Tim's very kindly offered that if you have any specific and direct questions for him and his team, they're very, very comfortable to take them by email at Sable. And we'll be giving out his email contact details in a follow-up email after this webinar. So thank you very much to you and your team for that, Tim. Before we sign off, if I may, I'd like to draw the audience's attention to a couple of forthcoming events and share some exciting developments, if I may. As we ready ourselves for the market launch of our Innate domestic platform, we've launched our new website. Please do go and have a look and check it out. I know many of you in the audience have interesting and valid questions such as, wow, you've been building this for ages. When is it going to be ready? How is this going to be different? And of course, what's happening to the standard list? I'm going to be addressing those questions and many others actually in a short video that I'll be recording and circulating soon. So please do look out for that. But in the meantime, please do check out our new website. Couple of notices. My colleague and teammate Steve Backhouse will host his monthly In the Room. He's got Stanlib in the room with him on 30th of March. Keep an eye out for those invites that will come out later this week. For the first In the Room of the year, Steve will be talking to Warren Buhai, from Stanlib's Absolute Return Investment Team about asset allocation amidst significant market uncertainties, I think. For April's in the room, we are looking at welcoming Dodge & Cox's Director of Research, Brian Cameron. Now, he's actually based in San Francisco, so we'll be starting that one an hour earlier for him. So we'll look forward to hopefully welcoming you to that one at 8:30 on the 20th of April. More information on that to follow as well. So this brings our financial emigration webinar to a close. I hope you've all found it helpful for both you and your clients. Don't forget that if you weren't able to watch from the beginning today, or you're watching the recording, and yes, there's been a few questions asking me whether there is going to be a recording. Yes, there will be a recording sent out by email afterwards. There'll be a short set of questions if you want to get your CPD point, and these will be sent to you after the session once you've registered, if you haven't been able to watch the whole thing through today. It only remains for me to thank my guest, Tim Powell, for sharing his enormous knowledge with us today. Despite not being a tax expert or a financial advisor, I think you'll agree with me that it was incredibly useful having someone with the perspective of exchange control talking to us today about what these new introductions in legislation mean. Thank you very much for joining us, and I look forward to seeing you out and about as soon as we can. Many thanks indeed.